Awesome. All right, we'll kick off. So yeah, first and foremost, thank you to everyone attending today through Apollo, our hyper founder community platform. Very much excited to catch up with you all today, and in particular, our guest Tom. By way of introduction, my name is Sam Cust. I'm one of the directors here at Hyper. Hyper has been around for 8 years now, with our mission to provide the safest way for founders to launch their startup. Today, we're going to be discussing how to get early stage funding, and I'm very excited to be chatting with my co-host here in Tom Smalley from Skalata Ventures, and we're going to be explaining exactly what they look for in a startup. And I guess this vision and understanding is widely shared within the investor community, so very relative to all conversations you're going to be happening or having at the moment. Today, we're going to be covering a few following topics, such as who are Skalata Ventures and Tom himself, what does a VC particularly look for when investing in an idea, how does a pre-revenue or pre-product startup show that they actually are investment ready, and the process that's involved in securing funding. We're also going to have an open Q&A throughout, so please feel free to use the chat function to ask any questions, and I will follow them on to Tom. So yeah, by way of introduction, Tom, thanks very much for joining, mate. Keen to hear a bit about yourself, a bit about Skalata, and then we'll dive into the fun stuff from there.
Absolutely. Thanks, Sam. Thanks for the introduction, and thanks very much for having me as well. And thanks to all the founders and others on the call that have joined today. I know how busy you all are, and I really hope we can make it an awesome hour for you and you get lots out of it. So just to introduce myself, I'm an investment manager here at Skalata Ventures. A little bit about Skalata Ventures. Skalata Ventures is a VC fund. We manage two funds. We're currently deploying our second fund, and we're really focused on finding early seed stage or pre-seed startups to back and work with to help them grow them into significant and sustainable businesses.
Fantastic.
If I can give a little bit more information on us, I guess one of the questions, I don't want to get too much of the sales pitch because I think it'll be important for, the founders to dig into a bit more of the details. But I guess what makes us different to a lot of other VCs out there is we like to get our hands dirty. And our idea is that we will get, inside the tent with you and, really help on building your startup at the really early seed stage. So helping you grow from the point where it might be just one or two or three of you as the founding team, and then help scale up the company through the seed stage. So we're looking to join you at the early seed stage part of the journey and then follow you through to Series A. That's kind of where we're looking to do, both in terms of support and money.
Wonderful. Thanks, Tom. Yeah, appreciate it. And just a question off the bat, how many, startups, just in 2022 alone have you guys invested into at that, early stage, if you know off the top of your head?
Yeah, good question. I think at the moment, and we're kind of furiously fighting to get a few closed out before Christmas, but we should be hitting around somewhere in the probably 15 number of kind of initial investments we've written into early kind of seed stage companies. And then there's a number of follow-on investments that we've done into existing portfolio companies in that period as well.
Awesome. Thank you. So it's been a busy 2022 for you, I can imagine. So yeah, thanks very much for taking the time to sit down with us today. So, a pretty, open question, but to really understand as well when looking and what founders can really understand of what they should get themselves to a level of is, what does a VC, look for when investing into an idea, say pre-product or pre at, market stage?
Yeah, definitely. That's a great question. I might take it a level up, even beyond that, Sam, to kind of explain a little bit of the context and then details on the pre-seed, early seed stuff afterwards. I think the most important thing I want to say to founders out there is to really understand the incentives that drive VCs in their decision making and the incentives that drive the individual members of the team inside the VC that you might be interfacing with during that process as well. And it's quite often where founders and VCs, misunderstand each other's incentives that a lot of the confusion and pain can result from. So really getting out there and reading, there's some awesome books out there. One that I always tell, founders to, go and read is a book called The Secrets of Sand Hill Road, which is written by a guy called Scott Kapoor, who's a partner at Andreessen Horowitz. And he really lays out in fantastic, short book, all of the kind of incentives that drive VC decision making and how fund economics and other things work. And as a founder, like having a base level understanding of what we're kind of basing our decisions on from a economic financial perspective and some of the restrictions that feed into that is such an important kind of first step before you even come and reach out to the first VC interaction that you might have at the early seed stage. And if you don't have the time to read through a whole book, there's plenty of great blogs and podcasts and stuff out there that can really help explain to founders what that incentive structure looks like. Specifically, more going back to your question, Sam, at the early seed stage, obviously it's difficult at pre-seed, early seed to really, make a decision based on the financial statements, because quite often there's not a lot of entries in them, at least on the, revenue lines. There might be a few on the expenses lines, but there's not a lot of data and metrics to go off. So really what we are looking for and what most investors at the pre-seed stage are really going to look for is a really deep understanding of a problem that exists out there that is not obvious, that not everyone else knows exists, or at least doesn't know exists in the way that the founding team knows it exists and understands the nuance of that particular problem. That's really the key thing that we're trying to look at, and getting a grasp of how big this problem is. And more importantly, if, regardless of what your product looks like, because your product may be non-existent or in a very, MVP or closed beta version of it, we want to get a real understanding of what value is going to be created when you solve that problem for the particular, customers or users out there who are going to be using your product. And there may be more, multiple problems that are involved in there, particularly if you've got, a marketplace business where you might be solving two problems simultaneously, or some SaaS products where you might be, the actual customer that's, paying for the product may be different to the user. So you might have to find the overlap and understanding between those two problems as well. I think outside of the problem, it's a really understanding from you as well, is like, as the team, what is it about you that makes you different and makes you uniquely qualified to be able to solve this problem? And pointing not just to things that you've done in your history, it's not just job titles that we're looking for or university degrees. It may be really proactive customer discovery type work that you've gone out there and gone, I've seen in my personal life as a consumer that this is a particular problem. But my experience as one consumer is not going to be enough to get a VC satisfied that an investment at the early seed stage is a good investment. And say you've gone out there and you've off your own back, you've reached out to 500 people on LinkedIn or Twitter, and you've surveyed them, periodically over a period of time, and you can present that survey data up to a VC to say, hey, this is what the problem is. These are the unique insights I'm bringing. This is a product I want to build. Here's the proof that I'm solving a problem that's real, it's valuable, and it's time to be solving that problems now. That's really what we're kind of, zeroing in on, is really problem and team are over-indexed at the early seed / pre-seed stage.
Yeah, awesome. Yeah, thanks, Tom. That's a thorough answer. And just to, I guess, break those down a little bit further. So yeah, what you spoke about at the very beginning is really understanding, I guess, the mindset and the incentive for a VC going into that conversation. So, as you kind of mentioned, understanding, okay, well, what is the return? What's the incentive that they're looking in now to what that future is going to have? And I guess understanding as well that, most VCs, as well as, Skalata, have your own kind of investment mandate. So the type of, I guess, platforms or startups that you do like to invest in. So doing that early research to really set yourself apart from other founders, I'm presuming, goes along the way, which is awesome. And yeah, second point that you mentioned is, very interesting. So understanding, I guess, element of, user surveys, or really understanding that the problem that you have is shared within a large pool of people that ultimately needs to or has to be solved. So have you got any examples? I mean, you mentioned a survey, but other ways that founders have come to you in the past and actually shown you that there is a problem that needs to be solved out there with actual backed up data, or emails from potential clients and these type of things that have, I guess, really impressed you?
Yeah, absolutely. I mean, the first one I kind of alluded to already, I guess, before, Sam, which is someone coming up to me with details on a Notion page that they put together of these extensive kind of user interviews they've done, everything down from not just the problem side of things, but what particular features they look for in a solution once it was developed. And that was for like a SaaS tool that was getting targeted at SMEs. So on that level, we're really looking for a large number of people to have, gone through that kind of user interview process or customer interview process at that particular price point, because the average kind of annual contract value or average annual revenue per user number for that particular customer segment is going to be very, low. It's going to be probably in the single digit thousands. So in those cases, we're going to want to see a large number of people having gone through that process. At the other end of the spectrum, if you're selling to enterprises and your average annual contract value is something like $500,000 or $1 million, some really strong indications, even from just one or even two customers, that you're going through a serious sales process with them. And you might not have the product fully built at this point in time. You may have some specs that you need to put into it, as long as it's not specifically, you're not becoming an outsourced contractor for that particular enterprise, and it can be replicated over, which is another point that I can speak to a bit more later. Having really strong feedback, whether it's email snippets that you're willing to share, or, even better, letting us jump on the phone and speak to them, which we understand is difficult because, there's complications there. And, sometimes it's awesome for us to do it. Sometimes we don't want to, set off a hand grenade in the middle of the sales process where the founders might have, presented the company in one way, and having us come in and speak as funders of the company to the sales team that you're working with there may not be the right way to go about it. But anything that you can give us basically confidence that what you want to do and what you want to build, if we're partly going to be funding it, is something that people are actually going to want to pay for, is all that it really comes down to. Because you're de-risking it for the investor, because the biggest fear that a lot of investors will have at the pre-seed, early seed stage is around paying, effectively for a really great product to be built, only to find out later on that nobody actually wants to use it or pay for it. That's the big risk that we're correcting against.
Yeah, definitely. No, that's a fantastic insight. And that's something that we really speak about, I guess, through our Accelerate process with our founders, is going out there and having as many conversations to get that feedback. And having actual conversations, whether it's through early adopters, whether that's a company or users, and around the pricing point. I think you made a really good reference there that it doesn't necessarily have to be, a signed contract or a letter of intent, but it's some sort of, I guess, inclination or an email back with a satisfactory level to be able to, I guess, show that proof to you as a venture capitalist, in order for you to get confidence in that, people are willing to pay for that solution. So yeah, that's great. So you've seen forms of emails, you've had some calls with potential users, you've seen a wide mix of things that you've seen as a level of credibility in order to invest, which is great. And then, I guess one of the things you spoke about when you mentioned that as well is around team. So understanding, I guess, as you mentioned, background, have they actually lived and breathed the particular problem before? How have you seen founders that have impressed you to be actually able to build a team around them, whether it's advisors, and do those things stick out to you as a sign of, I guess, early confidence to invest in a startup?
Yeah, absolutely, Sam. And I think, you touched on a great point. There's actually quite a bit of crossover between the question that we spoke about just then and the second question, because your ability to be able to sell your vision for the business and, the pathway forward is applicable across a number of channels. It's not just customers that you're selling to, it's also future employees and advisors, and it's also investors. So having a really solid group of people sitting around you, even if they're not on your books getting paid at this point in time, can also be a really positive signal. And I think it also helps founders, like at this particular point in time, the more resources that you can get in and around you not only helps validate the idea to a new investor, but it also really helps just reduce the workload and stress on you in this, absolutely most difficult and testing time of any company's journey in that first couple of years, because not having those people around you, to help guide you can lead to, overwork, and sometimes can also just, lead you to feel like you're in a bit of a lonely existence, at least the founders I've been working with. So getting those people in is really, really important for a number of reasons, not just, your own ability to execute, but also being able to get investors and more advisors and more employees on board.
Yeah, no, fantastic. I actually got an interesting question here from Lachlan Smith. Thanks, Lachlan, for your question. And I know we're speaking at the moment around, what have founders done in order to impress you? But I guess, what are you kind of finding is a common theme to those that ultimately you say not for now to invest in? That, I guess, is it not enough prep? Is it a lack of commitment? What are these things that you might see in order for them, or providing a lot of advice for them to go back and do before coming to speak to you again?
Yeah, absolutely. And thanks for the question, Lachlan. I think going back to that initial point, I think it's that really not understanding those incentives, and really understanding that there's heaps of good ways to build a business. Like there's hundreds of good ways to build a business. And say, for example, if there's 100 good ways to build a business, probably only 3 or 4 of the ways that you would build that good business are going to be venture backable. And when VCs often say no to a company, it's not necessarily because they don't think it can be a fantastic company. It just can't be a fantastic company and a venturable, backable company at the same time. And I think that's one of the biggest challenges that we have. And to give a kind of illustration of that, like in particular for the larger funds that operate in Australia, the Blackbirds, the Square Pegs, and the Airtrees of the world that have these really, really large fund sizes, they're really going to be looking for businesses that can grow into astronomically sized global markets that, you know, have the potential to grow into not just a unicorn, but like a 10x unicorn or a decacorn kind of valuation over a number of years. And I don't want to speak to individually what their mandates are, because I'm sure I'm not the most qualified person to be doing that. But understanding that they're going to be driven by a lot of that thinking is really important. And that filters down all the way to the kind of smaller VCs like Skalata that are playing at those, you know, early stages that we also have, you know, hurdles like that, for example, that need to be met.
Yeah, no, for sure. That makes total sense. So in terms of understanding for founders as well that are, you know, embarking on this journey or about to embark on this journey, I guess, what is the process that's involved once hopefully they meet that, you know, minimum criteria that we've spoken about in order to be attractive that would typically play out so they can kind of prepare their mindset in order to be ready to have investment conversations with the likes of yourself and other VCs?
Yeah, absolutely. I think the first one is getting real clarity around what you want to do with your business and really understanding what the goal is for you in, say, 10 years' time with the business and thinking about how that's going to interplay across all the things you want to do in your personal life and beyond as well. Because going down the kind of venture path is a tough one. It's not the right choice for every business and it's not the right choice for every founder because the pressures and kind of risk that's involved with it can be very high at times. So I think really getting, even before you put your hat in the ring to go and seek VC funding, really understanding that it is what you want. Because VCs do a really great job of advertising the dream and, you know, to all founders to say, this is the best path to go down. Because obviously as a matter of those incentives, VCs want to attract as many possible founders into their orbit so they can get the selection of the best possible founders and investment opportunities out there. So making sure that you take a step back and feel confident in your own decision that this is the pathway for you and your company is probably the first and most important step. I think then once you've done that, you're really just following enterprise sale principles from that point onwards. Because effectively you're engaging in with VCs an enterprise sale of equity in your company in return for cash and support beyond cash or other benefits that VCs may provide. What I would say at that point is that you just want to kind of exercise, you know, first principles thinking, which is to go out there, you know, figure out where you sit, map the market in terms of potential funders, get a really deep understanding of what particular segment of the VC funding market your company fits into at this point in time, and then making sure that you acquire as much learning and background as you can about the different kind of sub-markets within the VC world. You've obviously got VC funds that play at different stages. You've got VC funds that invest in certain themes. You've got VC funds that invest in certain industries. You've got VC funds that invest in certain types of founders and kind of finding where, I guess, the overlap in the Venn diagram is between you and those different VC funds. Once you've kind of then got your shortlist, it's really about doing a bit of your own DD as well. Like you might say, okay, I'm going to fit into these VC funds mandates, but going out and actually doing DD on these funds, even before you've made that first contact and saying, hey, there's a founder in the portfolio that I'm connected with on LinkedIn. I can see that he's or she's had investment from this particular VC. Let's go and reach out to them and see what they think. Do they think it's a good idea speaking to these people? If I do go and speak to them, what do you think? Do you think that I should come forward in this particular way? That can be a really helpful conversation to have first, because the more information you have in your, I guess, in your head before you go and take these meetings, the better, because it's going to result in a better meeting for you and a better meeting for us as well, because we'll quickly be able to, you know, figure out whether or not we're a good fit for one another, because the process of choosing is mutual.
Yeah, for sure. No, it's interesting. It's not just a spray and, I guess, pray approach. It's really just, you know, really understanding those core concepts and those listing, you know, working with the team at Hyper, that we were able to identify who we think, you know, is it a product, you know, what type of, I guess, investment mandate is each VC really looking for in order to be attractive to them. And as you mentioned, Tom, as well, I presume as well with, you know, some of your founders as well, because of the there are so many funds out there that sometimes it can be a bit of the founder interviewing you as well to ensure that, you know, you're going to be the right VC to actually work with them on the future of their business as well. Yeah, great. Yeah, a really interesting one here, I think was mentioned in the comment as well, is what you've seen in terms of how early stage founders are actually valuing their business, and how often, I guess, the conversation between you and the startup that valuation may change and whatnot. And then, because there isn't actually any much tangible, I guess, fiscal information, it's how does that actual number derived? And I guess how is the value of shares actually exchanged through equity?
Yeah, great question. I have to preface this by saying it's very much an art form rather than a science,
Mm,
in the same way it's very much a science when it comes to public markets, or at least it's closer to one. At the early stage, it's very much, each individual firm has a process. No one's doing a DCF valuation or a comparables analysis or anything like that.
mm,
And kind of going back, I guess, Sam, to those things we spoke about earlier, at least internally at Skalata, the way that we do it is really focused on, I guess, three areas. The first one is the kind of the problem. We're really marking the problem in terms of how big is it, how important is it, basically how much value can be created by solving this problem is kind of one area that fits into the valuation. The
mm,
second part is the team and getting a real understanding of, like, has the team got a track record of doing this before? Have they got amazing insights in this particular industry? Have they got a history of, basically resilience and persevering under some of the most extreme pressure that you're ever going to get when you're going
mm,
through this, early seed stage and then scaling process. And then the final one is around, some evidence of traction as well, whether
mm-hmm.
that be in the form of those surveys or other things. Obviously, with revenue, you're more likely to get a higher valuation. But across those three areas is where we do it. We probably have 40 separate data points that we crunch into an algorithm or calculator that we've built internally. And some of those are quantitative, some of those are qualitative. And once we kind of mark the particular company and founding team across those criteria, we get a range that's then presented. And that's
Mm,
effectively the basis of our term sheet will be set on that. Is that replicated across the board? Speaking to other funds, it's quite often a similar-ish process. Again, no one's
mm,
doing financial-based stuff at the early stage, but they've got their own quirks about what that analysis looks like. The obvious point is that if you're in a competitive process and say there's 3 or 4 funds chasing after one particular investment, the nature is that it operates like a really highly contested kind of residential property auction where everyone just starts bidding each other up, and the
mm.
valuation can then come detached from some of those calculators that people
Yeah,
put together internally.
yeah, no, makes sense. And that's something that, we really speak, highly of. One of those methods being the Berkus method, and I guess I think you mentioned 5 key criteria that you
Yeah.
value evaluation against, and that's why they're really important in terms of the founder of what to actually focus on and do before speaking to a VC or any investor. Because the more activity and the more areas of focus that you do in driving that initial traction, in driving the product, in driving the team, actually increase your valuation, which is really, really important. So yeah, fantastic.
Yeah.
Yeah,
If,
answer with that, Tom.
if I can have one more thing on that as well, Sam, is to
Yeah.
think that, don't obsess over valuation too much at the early stages as
Mm,
well.
yeah.
Obsess over how much you're going to dilute yourself down and monitor that, because you
Hmm.
don't want to get yourself into a position where you're selling, 30% of a company in a pre-seed
Yeah.
round or 40% of the company. Really focus
Hmm.
on raising as little as you can in order to hit the milestones that are either going to,
Yeah.
one, unlock your next funding round, or
Hmm.
two, get you to a position where you're actually cash flow positive, which is even better. Because at that point, you don't need funding. You may choose to go and
Yeah.
get it, but it massively increases your leverage at the negotiating table with a VC, an angel group, a family office, whoever it might be. If you can sit there and turn around and say, hey, I don't need your money. I'm cash flow positive. I've hit the milestones I
Yeah.
said I'd hit with my last round of funding, but
Hmm.
we want to accelerate growth and we think that you could help us do it. That kind of conversation is very different to a company coming to a VC and saying, hey, I run out of money in 2 months. Can you, help me? Because
Yeah.
the position of power that you're in is just completely inverse.
Yeah, definitely. No, thanks for that insight, Tom. And yeah, totally agree. That's something we really try to focus on, is saying, what's the valuation now? What's the limit of that capital raise? Because yeah, as you said, and there's actually a
Mm-hmm.
great question here from M, one of our founders, actually asking, what percentage should we be giving away? And as you mentioned, because I know we've gone through DD and some founders in the past where there might be some um, warning signs with cap table and not being, I guess, too diluted for a founder. So yeah, one of these questions, and I'll read it aloud now. Thanks, Sam. Is what percentage would be wise to actually get from a VC at this particular stage versus an angel investor and friends and family? What proportion doesn't really matter as long as the required funds are received.
Yeah, great question, Sam. And I think to go back again to the kind of
Mm.
initial point is to say that it really depends on what you want to do. So if you're setting
Yeah.
up your company as a JV between you and a strategic investor, and you know that
Mm.
this joint venture that you might be doing is going to be highly profitable, because by bringing on this strategic investor, you know that you're going to get access to their entire customer
Mm.
base, and that you could be in a very short period of time doing a couple of $1 million revenue a year, and might be enough to pay you and maybe your co-founder a fantastic salary, pay some dividends out at the end of the year as well. At that point in time, maybe you might make the decision that you should sell 30, 40, 50% of the company to that JV partner, and that business, just as a rule of thumb, is not going to be venture scalable, because the VCs won't like the fact that it's effectively controlled by one participant in the market, and that will basically
Mm-hmm.
say that it's not going to be a big enough market for the VC to be able to invest. But in those circumstances where you're not seeking VC funding, it actually may be appropriate to sell a large chunk of the company at that really early stage. If you, as a founder, evaluate all things on balance and decide that that's in the best interest of the company. If you're going down the VC funding route, it's a different equation, and it's really looking after yourself and your early investors, if you have any. It's really looking at it and going, okay, in order for us to become a cash flow positive business, we've built a model, or we've built out a plan which basically says that we anticipate, and this will be a bit of it's a difficult exercise to do because stuff
Mm.
will always change over time. But you kind of want to plan it out and go, okay, we think in order to get to the point where we want to, get to this company too, we're going to need to do 4 funding rounds. There's going to be a pre-seed type round to fund the build and the initial sales team. There's going to be a late seed round, as I'd call it, where you might raise $1 million to really kind of double down on that growth. And then you might raise a Series A after that, which may be say $6 or $7 million. And then after that, you might raise a Series B, which might be $30 million. At each of those particular fundraising rounds, you're going to have, a portion of the company sold. If you in that
Mm.
very first round sell 30% of the company, and you've only got 70% left after that for you to retain as founders, and then also to sell off in those future rounds, you're going to be in a really difficult position. And I'd say
Mm.
selling 30% as an extreme example is probably too high, in an early seed, pre-seed round, if I can call it that. Coming back to kind of what looks normal, I would say anywhere from 5 to 20 at the higher end would be considered the normal range that I've seen a lot of deals at that particular stage done. Obviously, that changes with market movements. Back in the end of 2021, it much likely would have been closer to 5. But,
Mm.
coming into the period we're in now at the moment, it's likely to be 10 and 20, between 10 and 20 at that particular point in time.
Yeah, fantastic. No, that's great. You mentioned something that I'm incredibly passionate about, and in speaking with our founders and getting, I mean, early stage traction as well. But he's talking about strategic investment, smart investment. For you,
Mm-hmm.
is that something that is really appealing? So, for example, if I've got a travel platform and I'm able to bring in a big travel partner, who's going to allow me to get exponential growth and access to their customer base and endorsing, who
Yeah.
may come on as not only a shareholder and provide some capital, but also is going to grow me out. Is that something that is really attractive to you, if founders have gone and secured a relationship like that?
Yeah, definitely. And I might split it into two groupings, Sam, to kind of
Yeah.
split the analysis a little bit. I think on one hand,
Mm.
you've got those quite wealthy business women and men that, for example, might have massive exposure to the travel industry because they were a founder of a really successful, travel business. Or you might
Mm.
have, a existing executive within one of those big businesses, like a Flight Centre or a Webjet or something like that, that's in that industry. And then on the flip side, you've then got the corporate venture arms of those companies,
Mm.
and you've got the actual companies themselves that might invest off their own balance sheet. I think on the first example, that's a massive positive indication to any early investor, because we look at it and go, okay, this particular woman, for example, that might write a large angel check into your round and is now advising you, has 20 or 30 years within the travel industry. When I'm thinking back to those early points that I was looking at in terms of what we're looking for teams that really can go out there and find these type of people. So getting those kind of people involved is a big tick on the team side of things. But then on the problem validation side of things, having someone like that involved in the company is also a validation of the problem, because this
Mm.
person might have 20 or 30 years knowledge in this particular industry. We're not experts in any particular industry at Skalata, as an example. We obviously do a lot of research on the investment by investment basis, but having someone like that on your cap table advising you and, you know, potentially available to us to jump on a call with at some point during the investment process to say, hey, why have you invested in this company? We'd love to talk to you about your experience in the industry. And she turns around and says, this is the most, you know, important problem to be solved in that industry. That's just a massive tick, tick, tick for us. And that would be a really strong, you know, way to bolster your, you know, attractability as an investment opportunity and company to partner with as a VC. The separate one to go down is the corporate venture one, which is a bit of a, or, you know, the company itself rather than the individuals involved in the company investing, because that can lead to a number of different outcomes. And again, it's really stepping back to the incentives. Corporate venture capital firms are investing in part because they need to be able to generate a return for the investors in their funds in the same way that, you know, traditional, I'll call it institutional VCs like Skalata are doing. The difference with corporate venture capital firms is they quite often have another incentive, which is basically trying to fight back against what I'll call the innovator's dilemma, which is that, you know, the old Clayton Christensen book, which again, another book I'd encourage everyone on this call to read if they haven't read it already, is really saying that big, you know, established companies with big established cost structures and incentives really struggle to deal with disruptive innovation, which is often what, you know, founders should be, you know, investing or building their company around. In those instances, they're quite often acting as an information gathering machine for the mothership, which is the corporate that they've been established under, or they're acting to serve the corporate's interests in another way. And that might be something as simple as going out and providing an ancillary service that the corporate knows its customers really, really need, and having someone who's outside the organization providing that service for them is really beneficial for the corporate for a number of reasons. And the classic example I think of recently, and I can't recall the exact name of the company, but there's a company that I believe Woolworths and Coles have invested in that has effectively an Instacart kind of type operation in Australia. There's an interest in them outsourcing that delivery system for reasons I won't go into outside of their corporate. So they've invested in that, and they hopefully see it as a good financial investor, but it's another one that will serve the company's overall interests. The reason why a institutional or traditional VC that's a pure kind of financial play VC might not like that is that the incentives between the corporate VC and the institutional or traditional VC might diverge in certain areas. So it can depend on, you know, those circumstances. However, that said, if the corporate VC is able to deliver, you know, a massive database of customers up to the venture investment, that may outweigh any perceived disadvantage in having those, you know, misaligned incentives over the long term. And it can be a really strong kind of, you know, indication from us to us as another investor. That's a great person to have on board. It's just not a clear, always positive one like it is in that case of the individual. It can be varied depending on the circumstances.
Yeah, cool. No, thanks, Tom. It's a really thorough answer in understanding as well. So I appreciate that. We've got some great questions there. I'm just going to hold off on them. I've just got a few things that I kind of wanted to discuss. You know, I'm really talking to these early stage founders, Tom, in terms of like tangible assets, in terms of presenting to you around the product and in getting themselves, you know, when they are submitting their application, in terms of the things that you do like to see in order for them. So some of the things that, you know, we speak about through our Accelerate program, which is matched off the back of, you know, what most VCs like to see. So some sort of, you know, we'll list these out, but what you like to see in terms of, you know, the prototype of the platform that they're going to be presenting from a product point of view, or is it an initial MVP? Like what are the, from that point of view, what is it that you kind of want to see from a tangible asset point of view?
Yeah, great question, Sam. I mean, it's very case dependent. We've got a preference for, well, it's part of our investment mandate, kind of going back to that thing of what effectively we've agreed with the investors in our fund as to what we'll invest in. And we're required to have a product that's either market ready or, you know, going to be market ready pretty soon. So for that reason, we're wanting something that's in a pretty late stage of development. So we, you know, typically ask for a video to be recorded of a demo. You know, if it's possible, we quite often ask for a login. You know, if it's a software platform, for example, we really want to get in there and play around and see what's there. The obvious kind of warning to that is to say that we don't expect this to be the fully scalable, you know, product that is going to, you know, be able to, you know, handle 100,000 users in 3 years' time when you've, you know, got millions of dollars in revenue and probably raised millions of dollars as well for that process. We know it's going to be scrappy. We know it's not going to be scalable. We just want to see, I guess, some idea of the founder's vision as to what this product looks like. We don't expect the UI and UX to be perfect. We expect there to be bugs every now and then, but we just want to get a clear idea of what it looks like, because we want to square that idea of what it looks like with obviously the problem that you've told us about, and how obviously your solution or your product is going to actually solve that problem.
Yeah, fantastic. No, it's a wonderful insight. And so adding to that, not only, I guess, an idea of what the MVP is going to look like in terms of, we see pitch decks and everyone's got their kind of play on it, but, from your point of view, what's really important to see from an investor ready pitch deck point of view in order to really attract attention to get that meeting with you?
Yeah, definitely. So on that, I'd say kind of two things that, and these aren't golden rules, but two things that I see that really impresses me with founders. I think the first one is to say having two decks. So having an initial deck, which I'll call like the teaser deck, which is effectively something that's around, 10 to 12 slides, that kind of sets it out at a really high level, what the problem is, who you are as a team, what your proposed solution is, and I guess any evidence that you've got of traction today, like just at a really high level, laying out that, and kind of treat this deck as the one that you wouldn't care if, how would I say, like your number one competitor gets it, because other than the idea, there's not going to be much, IP or information in there. And the idea of this deck is to just get the VC or investor to take that second meeting. Once they've decided to take that second meeting is when you then wheel out what I'll call the more fulsome deck, which may be something that's probably 20 to 30 slides long, hopefully not too much longer than that, because you don't want to overload the VC or investor with too much information. And that will go into much more of the details around each of those four items I've just covered off. I think that's really important to have the split between those two, because I think it's in founders' own interest to do it, because you don't want to disclose too much, but you also want to make the investors' decision-making process quicker and show them enough to be interested in hearing more later on. I think the second point is to say, invest in a good designer on, Fiverr or Upwork or whatever it is. Like,
Or
don't
Hyper.
spend, or Hi-Fi. Go and do that, because the reality is that you can be doing better things with your time than spending hours and hours making sure that everything's lining up and it's all looking pretty. And don't stress, like, don't think, make me wrong, but like, you do need to do it, because there are certain VCs out there. I don't care too much about the form of it too much. I'm not an ex-consultant or banker who obsesses over the perfect kind of slide deck in the way that others might. But people will kind of get the wrong first impression if there's typos and it's scrappy and everything like that. But the amount of time that it takes to get that right can be just too long and a bad use of your own time. So outsource it where you can and you can afford to do it. And if Hyper can do a great job, then you know exactly where to go to.
Thanks, Tom. Appreciate it. But yeah, that's a really good insight. And then adding to, I guess, what you want to see from that point of view. So things like, cash flow forecast and cap table, I presume, are the type of other tangible assets that you want to see during that conversational stage.
Yeah, definitely. And every VC's process is different. And that's why, going back again to the start, I encourage everyone to go out and kind of get a sense of what they look like beforehand. But most VCs are always going to ask for a copy of the cap table, and then also a copy of a cash flow forecast or financial model. Now, this doesn't need to be a 3-statement kind of, really nice piece of work that, if you've got a finance background, you might have spent a week putting together, or if you're not from a finance background, that you might have spent $4 or $5 grand getting a VCTO to put together. No one's expecting that at this point in time. But having a really kind of robust cash flow forecast with inputs that you can vary, as things change over the course of the year, and particularly be able to show, a base case scenario, a really positive scenario, and then, for example, the worst case scenario where, for example, you don't get any revenue for a whole year. Having that kind of built in is another massive advantage to us, because it gives us a real understanding that you're able to kind of predict out the future in different situations, and you'll be really quickly be able to adjust your business decision making as you, adapt that model and implement the real world data into it.
Yeah, fantastic. Thanks, Tom. And with those as well, Hyper, we've got, cash flow forecasts that have been templated for that avenue too. And just that last one around a cap table. So I guess for you, it's really important to understand, who are the investors, who else is on the team that you're going to be involved in.
Yeah. And I think I saw a question from George up there, that kind of touches a little bit on this. Like, when you do bring on an investor as an equity investor who holds shares in the company, it is like a marriage there, except there's no real divorce process, at least, without both parties like opting into it. So for that reason, every VC or investor that's going to look at investing in your company is going to want to see effectively who else beyond the founders that they're kind of entering into this marriage, so to speak, with. So it's really important to show that through the cap table as well.
Yeah, fantastic. So yeah, just before I go on to a few of the questions, I guess in terms of the landscape for 2023, Tom, I guess what are you seeing? With Skalata and the wider, and I guess confidence for early stage founders going through this journey from next year and the years ahead.
Yeah, it's going to be. I mean, I can kind of give a few points and pontificate a little bit, but I definitely wouldn't take any of what I'm saying as literal advice or a really solid prediction of the future. But I can share a few thoughts about what I kind of see happening at the moment and how that may play out into 2023. I think there's definitely been a slowdown. I mean, there's been a slowdown. Everyone's seen that in the data. The amount of investments that are getting done in Australia and internationally has dropped off massively. But two things on that'll kind of impact what 2023 looks like. 2021 wasn't a normal year by any stretch of the imagination in the technology space or the VC funding markets. And for that reason, it's not going to be repeated again for a while. And we've kind of returned to a more normal period. But the flip side of that is to say that during that kind of funding rush in 2021, late 2021, start of 2022, there was a lot of VC funds in the Australian market in particular going out and raising massive funds. I'm sure you've seen press about a lot of them. So a lot of these funds are actually sitting on large amounts of capital. And every day that capital is sitting in the fund's bank account and not invested in a startup, it's compounding at theoretically a much lower rate. So when VCs are incentivized to go out and deploy that capital at some point, I think a lot of VCs this year have kind of hit pause for a little bit. And I'll get into the reasons why that has been the case in a second. But at some point, they're going to have to, hit play and they're going to have to start investing again. And I think we're starting to see a bit of that now, and it hasn't dropped off a cliff. And I think that we'll see, as people become a bit more familiar with what the environment in 2023 and beyond is going to look like, there's likely to be a pickup in investment activity, just purely on the basis that the two things that kill VCs investing or anyone investing is uncertainty. Once some of that uncertainty around interest rates and war in Ukraine and other things and that real macro level have been resolved a little bit, VCs are going to have a much clearer or be able to predict much more clearly what they think is going to happen in the future. And for that reason, they're more likely to make decisions rather than be in this state of inertia that they're in at the moment. And I think that's one of the key things to say is like once that normalizes, VCs are sitting on a lot of money at the moment and they're going to have to invest it somewhere. So it's probably likely to see an uptick in investment activity, I think.
Yeah, fantastic.
That said, if interest rates keep going up and home mortgage rates go to 10% and the economy really does tank in Australia, there's likely to be, implications from that as well. And I think the other side to say is, although it's difficult from a fundraising perspective, all the founders on the call, if you haven't been having conversations about hiring people, I'm sure you will soon. Those conversations have been incredibly challenging the last couple of years. Like trying to hire developers and good salespeople has just been, such a challenge for anyone out there with funding. And although, for example, people were able to raise larger amounts of money over the last couple of years, a lot of that's been eaten up by having to extend in paying for engineers and product people in particular, and also sales people as well. So for that reason, with those salaries dropping off and the market becoming much more, I'll call it hirer friendly next year, you also see that offsets some of the lower funding amounts and lower valuations that might be on offer. So there may not be as negative impact as large as what some people may think.
Yeah, cool. Thanks, Tom. It's a really interesting insight, and appreciate that. Hopefully good foresight. Just going through, a few questions here. So thanks, Rowan. So just regarding Skalata, have you guys ever invested into first-time founders or teams, or do you need to have traction from previous ventures?
No, we always love to speak to first-time founders. I would say, there's probably two groups of first-time founders. There's first-time founders of SaaS, scalable, or other scalable VC-type businesses, and then there's first-time founders of any business. We'll invest in both of those. I mean, we have a real strong belief that part of the reason Skalata exists is to really provide the support and capital to empower first-time founders to be able to grow their businesses in a way that some other funds may typically not focus on. So we have a really strong emphasis on investing in first-time founders. We invest in second-time founders of both scalable VC businesses and, other businesses, like you might have founded a services business or an e-com store or something like that. Anything that kind of goes across those things is always interesting as well.
Yeah, cool. No, thank you. Just a question here, just to get some clarity around an earlier statement around, an MVP or some sort of product that you can play with before investing. So understanding as well, early stage founders, before they've been able to gain a serious amount or a further amount of funding to invest in actually the development of the platform. But are you happy to look at, a prototype that's clickable and fully functioning without the back end in order to, go through the conversational element from your end?
Yeah, absolutely. And I think one of the awesome things about being a founder in 2022, 2023 is you've got these amazingly powerful tools that you can use to mock up things pretty quickly. Like Bubble was a classic example of one where you can mock up something pretty quickly that's fully operational. And being able to build something quickly on there, go to a VC, say, hey, I've built this thing, I've sold it to 3 people already. They're using this base version of it, but I need some funding. And I need some funding to build it, to either go and speak to someone like Hyper or go and hire a developer in-house to go and do it. There's not as much as a barrier to entry as there was in the past to be able to build something. And so therefore, I would say VC's expectations of what you need to present before you are able to, in effect, be able to be eligible for investment is likely to be higher. Whereas in the past, it may have been easier just to do literally some mock-ups of some wireframes and other things inside a deck. I think VCs now will expect a little bit more in terms of, vision for what the product looks like than just a pure visual representation of it.
Yeah, cool. No, that's wonderful. I'll probably give last chance for any questions as we wrap up time here. But yeah, Tom, been great to chat. In terms of getting in conversation with you at Skalata, not only would once hit the eligibility criteria from a Hyper perspective to be passed forward, but anything further from Skalata's point of view, or any other events coming in 2023 that you'd love to speak to any founders on, invite or whatnot coming through.
Yeah, I mean, the first one is that our email inboxes, our Twitter DMs, our LinkedIn DMs are always open. So if you need to get my email off Sam, I can drop it in the chat now. Hey. Do reach out. I've got Tuong Tran, who's one of my colleagues on the call as well. Add us on LinkedIn, follow us on Twitter. We are always open for a chat, even if it's those early stages and you might not be ready to ask, particularly for funding now, and you're just wanting a little bit of advice on a quick phone call or something like that. Always happy to do it. I think in 2022, we've got a whole series of events planned. If you follow Skalata Ventures on LinkedIn or Twitter, we'll share details of those. We're predominantly based in Melbourne, so a lot of the in-person things we do are down here, but we're up and down the East Coast and across to Perth and Adelaide pretty frequently. So watch this space for some hopefully awesome kind of in-person events and drinks on Skalata or one of our awesome kind of ecosystem partners in 2023 as we kind of fully embrace a proper event schedule post-COVID, I think, for the first time, which will be really, really awesome.
Yeah. Fantastic, Tom. Yeah, appreciate it. And just second to that, any kind of questions, feel free to post in the Ask an Investor section in Apollo as well to get them answered directly too. But yeah, Tom, super thankful on behalf of all the Hyper founders and here at Hyper as well, and Apollo members for you jumping on today. Super insightful. We'll put together, a recording of this blog for those that want to rewatch it or haven't been able to join us with some key summarizing dot points. But thank you very much. And appreciate everyone for being involved today who joined on as well. Have a wonderful afternoon, everyone, and look forward to an exciting 2023.
Thanks, Sam. And it's just the last point. I might even send you a little list of some of those resources around understanding kind of how VC works. And if it's helpful, I'll either send that across on Apollo or get you to send it out to all the founders on the call.
Awesome. Wonderful. That's great.
All right. Thank you, Sam. Thanks, everyone.
Cheers, Tom. No worries. Bye.